Good afternoon, everyone. Welcome to the Historic Tax Credit Coalition's webinar on investing in Main Street and earning CRA credit for historic tax credit investments. My name is John Leith Tetro. I chair the Historic Tax Credit Coalition. We are an industry group that has been working hard for the last 3 years to make Congress aware of the importance of the federal historic tax credit, and we expect to be on the Hill advocating for its retention in a reformed tax code as that debate begins in Congress. Before we begin, I have a couple of housekeeping items. You will all be on mute throughout the webinar. If you are seeing images on your screen but don't have audio at this point, you may have forgotten to dial in to the phone number and the room number that's shown currently on the screen. If you want to ask questions, there is going to be a chat box appearing on your screen, and please don't hesitate to type in a question. We'll be taking those questions at the end in the order that they were received. We'll be sending you a copy of the slideshow as well as an audio tape after the session. Please feel free to pass it on to others who weren't able to make the session today. And now it's my pleasure to introduce our panelists. To my right and to your left on the screen is Barry Whitus, who is Deputy Controller for Community Affairs at the Office of the Controller of the Currency, and we'll be using the acronym OCC throughout the webinar. Sharon Canavan, who's the Community Development Expert at the OCC. Leanne Smith, who you don't see on your screen, she's joining us remotely from Charlotte from Bank of America. She is a Senior Vice President and Tax Credit Equity Originations Manager with Bank of America. And to my immediate right is Meryl Hoopengardner, who's President of the National Trust Community Investment Corporation. So we wanted to start out just with a quick discussion of the purpose of the webinar. It's to make participants aware of new guidance that's been issued by the federal bank regulators that for the first time clarifies when historic tax credit investments qualify for consideration under the Community Reinvestment Act. Sharon Canavan will be reviewing that guidance and providing some overall background on how CRA works, what qualifies and what doesn't. Leanne Smith is going to be talking from a banker's perspective. Bank of America has been heavily involved in historic tax credit investments over the years, and we'll be talking about what kinds of things she would like to see in a presentation from a developer or a community development director or Main Street manager as to what kind of things she wants to hear and see to determine whether a project qualifies for CRA from her perspective. Meryl will be illustrating from case studies how this new guidance can incentivize investments in older commercial areas that are in need of economic development. This webinar is not intended to be a primer on historic tax credits. We are assuming that participants have some familiarity with the basics of federal and state historic tax credit, but it's important to note that in our discussion today, what we say about historic tax credits at the federal level and how it interacts with the Community Reinvestment Act is also equally applicable to state historic tax credits and any loan that you may be seeking for a project that you're doing in your local community. If you have any questions, basic questions about the historic tax credit, you can go to historiccredit.com, which is on your title page of the presentation, and go to the Contact tab and send an inquiry to us, and we'll get back to you within 24 hours. Let me also give you a little background on the Community Reinvestment Act. It was enacted by Congress in 1977 in reaction to the practice of redlining or denying loans to businesses and homeowners in low-income communities regardless of their credit worthiness. The law requires banks to make affirmative efforts to meet the credit needs of all of its depositors in what are called designated assessment areas within their retail footprint. And they need to report those efforts to bank examiners as part of what are called community reinvestment examinations on a periodic basis. So to be clear, when we talk about CRA credit, we're talking about an incentive and a regulation. It's not a financing mechanism. So, you're earning credits you can monetize or turn into cash from the historic tax credit, but CRA is a regulation and an incentive to do those investments. So it is a strong reason for banks to take a harder look at a historic tax credit investment or a loan that they might otherwise pass on due to perceived higher risks. And as an ex-banker, I can tell you that financial institutions pay attention to these requirements because there are potential penalties and bad public relations, frankly, that can result from noncompliance. And so this law drives billions of dollars of investments into areas in need of economic development on an annual basis. So that the application of CRA and how it views, the regulation views historic tax credits, it's always been a gray area. One of the beauties of the historic tax credit is that the market decides what the building will be reused for, and so it best fits into the needs of the community. But not every use is an eligible CRA activity. And so what we, as a coalition, tried to do with the bank regulators over the past year was to ask them in their new Q&A guidance, which came out in July, to verify and clarify when historic tax credit investments qualify for CRA consideration. And so they asked for those comments back in fall of 2015. The new guidance came out, as I said, earlier this summer, and Sharon Canavan is going to be expanding on what that guidance says. But as you listen to our speakers today, I would encourage you to focus on the more nuanced eligible CRA activities related to small business development, job creation, and other activities that support the goals of local economic and Main Street development plans. And also, please pay attention to the description of rural middle-income areas that qualify as target areas for CRA activities that may provide opportunities for small towns and designated Main Street communities. And so with that, I'm going to turn the discussion over to Sharon Canavan. Sharon?
Okay. The Office of the Comptroller of the Currency supervises more than 1,400 national banks and federal savings associations. Under the Community Reinvestment Act, the OCC, along with the FDIC and the Federal Reserve Board, are charged with assessing each financial institution's record of helping to meet the credit needs of their local communities. Banks are evaluated for their retail lending and banking services. Also, the agencies evaluate the community development activities of intermediate small banks, large banks, and wholesale or limited purpose banks. Today, I'm focusing on how historic tax credit investments may be considered as community development activities under the CRA guidance contained in the interagency questions and answers regarding community reinvestment that were issued in July 2016. A particular historic tax credit investment must fall within one of the following categories in the CRA definition of community development: affordable housing for low or moderate income individuals, LMI for short, community services targeted to LMI individuals, economic development by financing small businesses or small farms, or revitalizing or stabilizing underserved or, and this is a mouthful, distressed non-metropolitan middle-income areas, those are generally rural areas, LMI areas, or designated disaster areas. Second, the historic tax credit investment must also meet the CRA's geographic requirements by being made in the bank's assessment area or areas, or within the bank's broader statewide or regional area. As a general principle, either a majority of the investment's dollars must go to a project that has a primary purpose of community development, or a majority of the persons benefiting from the activity must be LMI, small businesses or small farms, or be located in targeted areas. Examiners also evaluate the responsiveness of investments to community development needs. This element considers the volume of community development investments as well as more qualitative factors. We look at several things. Does the investment meet identified community development needs? What is the impact or benefit to community? Also, is specialized expertise or effort required to make the investment? We also look at the bank's performance context, which considers an institution's capacity, business strategy, the needs of the community, and the opportunities for investments in the community. With that as background, let's move on to a recent clarification regarding historic tax credit investments that the agencies made when we issued CRA Q&As last July. Although public commenters had urged the agencies to add historic tax credits to the list of transactions presumed to qualify under CRA, we concluded this would go beyond the regulatory definition of community development. However, the agencies also felt further clarification made sense. Therefore, a discussion in the preamble to the CRA Q&As was included, which explains that historic tax credit financing that meets any of the criteria under the definition of community development could be considered as qualified investments. So let's go through those categories to explain what this means. Usually, to qualify as community development, LMI individuals must receive a majority of the benefits to satisfy the primary purpose requirement. However, affordable housing is treated a little differently. Pro rata consideration is available for a mixed income affordable housing project or for affordable housing with a government mandated set aside. For example, the qualified investment amount would be $1 million for a $10 million investment in a historic tax credit housing development with a 10% set aside for LMI units. There's another wrinkle to be aware of here. The entire amount financed for a low-income housing tax credit project is considered as a qualified investment, even if only a portion of the units are affordable and eligible for the LIHTC credit. It is also fairly straightforward to demonstrate that community development activities include historic tax credit investments in community facilities that serve LMI individuals, such as small business incubators or workforce training centers. The primary purpose of community development can be demonstrated by providing information about the number of LMI individuals served, or by showing that at least a majority of the dollars invested will benefit LMI individuals. The next category of community development is economic development by financing small businesses, which requires more explanation because this category involves both a size test and a purpose test. A project that finances businesses with gross annual revenues of $1 million or less, or businesses that meet the size eligibility requirements for small business development companies would meet the size test. And this limit could be more than that $1 million. This is set by the Small Business Administration. To meet the purpose test, an investment must support permanent job creation, retention, and/or improvement for LMI individuals or in LMI census tracts or in a government-targeted redevelopment area. The other activities listed on the slide also meet the purpose test, but are unlikely to involve situations related to historic tax credit investments. To make this easier to grasp, let's move through several examples. In the first case, a bank invests in the renovation of a building that will house small businesses with gross annual revenues of $1 million or less, and that ultimately will provide 100 new permanent jobs. The investment will be considered to be more responsive if at least a majority of the jobs are for LMI individuals. For example 2, the investment is made in an LMI area. The renovated building will house small businesses that meet the Small Business Development Company size and eligibility standards. Again, that revenue threshold might be higher than the $1 million. Those businesses will provide permanent jobs that improve employment opportunities. The last example involves financing to renovate a commercial building with existing small businesses. The historic structure is located in a government-targeted redevelopment area, and employees will return once renovation is complete. So the investment helps to retain permanent jobs. There are 4 types of areas covered under the series of Q&As that cover the next category of community development. That is revitalization and stabilization. For the 3 types of areas that you see on this slide, the activity must help to retain existing or attract new businesses or residents. The investment must be consistent with a revitalization or stabilization plan, although the formality required for these plans and the particular type of activities that qualify may vary somewhat. In LMI areas, rehabilitation of the historic property simply needs to be consistent with a formal or informal community plan for revitalization and stabilization. In both designated disaster areas and distressed non-metropolitan middle-income areas, the activity must be consistent with a disaster recovery plan or a bona fide government revitalization and stabilization plan. In designated disaster areas, historic tax credit financing will most likely qualify by providing community services or rebuilding needs. In distressed areas, financing for historic properties would need to provide either essential infrastructure or facilities necessary to attract or retain businesses or residents. Even if the historic tax credit project meets all of the requirements that apply in any of these areas, greater weight is given to activities that are the most responsive to community credit needs, including the needs of LMI individuals or areas. Here are a couple examples where financing will qualify to revitalize or stabilize these 3 different types of areas. A commercial space in an LMI area, or the restoration of historic homes affected by a disaster, or rehabilitation of a historic property as a mixed commercial residential space in a distressed rural middle-income area. Finally, activities that revitalize or stabilize an underserved non-metropolitan middle-income area qualify, but only if the community development investment meets essential community needs. This is a different standard than I spoke about in the last 3 categories, where investments must attract or retain newer existing businesses or residents. Here, for example, if there are insufficient or inadequate medical facilities in an underserved area, a historic tax credit investment in a community health center could meet the standard of addressing essential community needs. The Q&As also clarify that essential community needs are met when LMI units are included in mixed income housing. The next 2 slides provide information about CRA that is on the ffiec.gov website. The CRA Q&As are here, as well as lists of distressed and underserved census tracts. There is also a geocoding system that lets you fill in an address that will populate a chart with more granular census tract level data, such as median area income. To finish, I'd like to point out that the OCC has a number of publications pertaining to historic tax credits on our Community Affairs website, which can be found at occ.gov. There are also extensive materials regarding the CRA. With that broad overview, the other presenters will now discuss specific examples of their work. Thank you.
Thanks, Sharon. And now we'll go to Leanne Smith, Bank of America.
Thank you. If we could get the next slide. So I'm going to talk a little bit about Bank of America's history with investing in historic credits, and also some of the things that we look at, particularly when working to make sure that transactions will be CRA eligible. So the first slide is just a generic overview of the bank as an investor. So you'll see here that we made more than $1.5 million in tax credit investments out of our community development bank last year, which included historic but also low-income new markets and some renewable credits for solar facilities. In the last 15 years, we've done more than $1 billion in historic tax credit investments in some really large and well-known projects across the country, and also some smaller community facilities and apartment communities and things that aren't as well known. So we have a full spectrum of investment types. Can I get the next slide, please? So why does Bank of America, why should other institutional investors invest in historic tax credits? This is a framework that my boss uses a lot when talking about our tax credit investments, and that's the 4 R's. So the first of these is relationships. Bank of America is obviously a major commercial lender, and we have a number of development clients who are working on projects around the country, as well as other clients who have a historic facility that they want to renovate. So we feel like part of this is being responsive to our clients' needs. The second component is the return. So when you compare the returns on historic credits with other tax credit investments, as well as other lending returns from loans and other investments, the historic credit stands out well for its risk-adjusted return. The third component is what we're talking about here today, and that's regulation. So while not all historic tax credit investments are CRA eligible, a number of them are, and so it's an important component to CRA responsibilities. And then the third is just overall corporate responsibility. Even if investment isn't going to be eligible for CRA credit, it's still worthy often of being done, because it's an important component of the fabric of the community where Bank of America is, where other community partners are, and we want to help restore historic character to neighborhoods and protect the urban core. So that falls into the responsibility category. Can I get the next slide? So we do these transactions in a couple of different ways. The first is in the legal structure. Those of you who are familiar with historic credits know that you can invest in properties using what's called a direct investment or single-tier investment, or also a master lease partnership, and we do transactions using both of those structures. We really like multifamily residential, also do retail and commercial space, specialized use projects like community facilities. One of the key things for us is making sure that this is not a developer's first time dealing with a historic rehab. We don't want to be somebody's learning opportunity or training ground. Historic projects are more difficult to develop than traditional new construction is, and there's some learning curves that come with that. So we want folks that have some experience with this program. If we could go to the next slide. The big thing from an investor perspective is what could cause recapture of the tax credit. So with historic credits, some of your capital, particularly to be compliant with the safe harbor, some of the capital is coming in up front when you close it to the investment. The majority of the capital will come in after the project is completed and then get to its Part 3 certification. And then you have a 5-year compliance period from the time that the property has been placed into service. And so as an investor, we certainly want to make sure that there's nothing that's going to happen that's going to cause the government to come back and recapture those credits. So the first is that you need to remain as an income-producing property during that 5-year compliance period. There cannot be a significant change in ownership or control of the property. The physical condition needs to remain as it was approved by the Park Service in their Part 1, 2, and 3 process. And then third, you have some tax restructure risk if there's an audit of the project and the IRS says you didn't comply with certain requirements. That could cause recapture. So that's another reason that we and most other major investors want to make sure that we're staying within the safe harbor provisions. The next slide, please. In general, I think it's important to note, especially for institutions that are considering an investment in historic credits, we've had very little instances of recapture, less than 1% of the overall portfolio. Now, that doesn't deal with other losses. Certainly, historic investments are a true real estate investment, and that means that the underlying properties, some of them will perform better than you hoped, and some of them will do worse. and you hope through good underwriting that the majority of your properties are going to be in the good category, but all of them aren't. And so we have had instances where we were not collecting the full amount of the cash that we had anticipated was going to flow through, either in the form of a preferred return or a share of operations, or possibly exit proceeds at the end of the compliance period when one goes to exit the investment. So this number is not reflective of how the overall portfolio has done on a pure economic basis, but in terms of recapture itself, we have not experienced very much recapture at all. And that's because we deploy a couple of key asset management tips. The first is strong communication. Having it's a partnership, it's an investment relationship, and so we want to stay in touch with our partners and make sure we're staying out in front of any potential issues or challenges. The second is that the IRS has released guidance within the past 12 to 18 months, creating a safe harbor, and we want to make sure that we're staying in that so that we don't have challenges with the structure being overturned. And then the third is in terms of exit. Exit expectations should be set up front. This is what we're looking for. This is what it takes for us to get out at the exit, and those kinds of things will help avoid issues later on. The next slide, please. So in terms of the purpose of today's conversation, which is about, well, how do you get CRA credit for historic investments? What we do is we go through this list of factors here, which we'll talk about, and we prepare a memo for, we're regulated by the OCC, so for Barry Whitus and his team, and send it to them when we're working on an investment to say we believe that the project would qualify for CRA based upon these factors. If there's a question, we're going to raise it early, and we're going to call Barry and the folks on his team to say, hey, what do you think about this one? We think this is why it works, but we're not totally certain, and so we want to get that guidance. But the factors that we're thinking through and talking about with our regulators are, if you're qualifying the project because it's in a redevelopment area, as Sharon noted, that's one of the factors that's eligible. Well, how does this development fit within that plan? How does it contribute to the revitalization of the community? Are there units of affordable housing? Is there some kind of training program or other services that are being provided to that low-income community? You want to be able to document that. We focus a lot on deals that don't have housing. We talk about the job creation. In some ways, it's similar to the New Markets program in talking about it's not just jobs, but it's quality jobs. What are the benefits that are offered? How many of these jobs will be accessible to LMI people? What sort of programs are offered for those employees? If you're focusing on small businesses, it's a similar story of what are the businesses. What are the benefits to the business of this program, and how is that going to help them? A lot of deals, particularly if they include the deals with the low income and the historic credit, focus on affordable housing. And so you want to talk about, well, what are the number of units that are being created targeted at low income people? What are the set asides? Are there any other special population targeting? And then finally, what other kind of government programs, subsidized sources of financing are involved in this project? How have they leveraged community funds, particularly if you're making a case that it fits within economic or redevelopment district and they're getting funding from that city or county or a special geographic area of that for redevelopment. Those are all cases that would contribute towards the project being counted for CRA. So we put those kinds of variables together in a narrative that we submit to the OCC. Sometimes before, if we have questions about it, other times in the after the fact notifications, so that it's documented for both parties. So that's sort of how we do this at Bank of America in terms of the CRA qualification. And now Meryl is going to talk through some case studies and examples of how the trust has applied this program. So Meryl?
Thank you, Leanne. So Leanne and I can fortunately switch out some of our examples. We've been lucky at NTCIC to work with Bank of America for many years, since we started in our role as a wholly owned subsidiary of the National Trust for Historic Preservation as a tax credit syndicator. So we work with financial institutions and other investors to originate, underwrite, close, and asset manage credits that we consider the economic development credits. We focus primarily on historic and new markets used together and solar credits, and we've done a little bit of low-income housing as well. So the majority of the investments that we make, and really the super majority when you look across our entire portfolio, are projects that are either invested in low to moderate income communities or ones that are in areas of high poverty rate or other areas of economic distress. So it's excellent news from NTCIC's perspective that we have this additional guidance that we can use to work with our investors and help them see how investments that may not have been on their radar, especially if their areas of expertise and tax credits have been in affordable housing or the new markets credit, how the historic credit can be viewed as another tool in the toolkit to meet their CRA obligations. So for purposes of today's discussion, as Sharon mentioned, you can get some essentially automatic qualification of projects if they are also low-income housing tax credit projects or also new markets tax credit projects that are used together with historic. And the credits in each of those instances twin nicely together and are often critical in terms of using both types of resource to get a project done. But we're going to focus on what can be the more under the radar historic only transaction opportunities and how these can be considered CRA eligible transactions. I'm going to focus too on the two prongs of the guidance that are also the ones that are kind of harder to dig into, as it's really a facts and circumstances analysis, especially those that focus on economic development and the revitalization prongs. So this is one of 4 case studies that I'm going to give you some highlights about. 2 of these are smaller Main Street type investments, 2 are larger redevelopments. If you look across the portfolio of activity of everybody who's ever used the historic tax credit, the peak of the bell curve is actually around $1 million in credits. The super majority of investments that are made for historic credits are around $1 million in credits. So these are $5 and $6 million Main Street projects that are revitalizing communities outside of large cities and really driving economic activity in smaller towns and communities. An example of this is an investment that we made to the 500 block of Gay Street in Knoxville, Tennessee. This is a Main Street that's typical of, unfortunately, many, where downtown shopping districts have fallen on hard times with suburbanization and retail malls that drew people out to the suburbs and caused many of the downtown historic properties to fall into disuse. Originally, this block accommodated the kind of retail outlets that now we only see in strip shopping centers and malls, but at the time that this was developed, it had the iconic S&W cafeteria, which was an opulent 2-story Art Deco building that opened in 1936. After the disinvestment that happened in downtown Knoxville, we were fortunate to come in with a small investment and redevelop the property so it now contains a cosmetology school, a gelato and deli shop, a restaurant, and 2 other small businesses. Like in many historic districts, the 500 block of Gay Street is adjacent to some other iconic historic properties. So as we saw economic development activity picking up in this community, a lot of it also drew from the redevelopment work that was done in partnership with Bank of America's Historic Tax Credit Syndication for the Tennessee Theater and the adjacent 8-screen Regal Cinema that was done nearby. Regal is headquartered in Knoxville, so it's an important local partnership in the community to be able to do this redevelopment effort together. So if we think back to what Sharon's requirements were as we look at this Q&A guidance that we have before us, we look at several different things. The threshold question is location, location, location. So is it located in a low to moderate income census tract? Does it also have other characteristics, or alternatively have other characteristics that have it in a federal, state, or local economic development district? In this instance, the project fell into both. It's a low-income census tract that has several other economic distress characteristics that are supervised in different economic zones. One thing I'll note about how you determined location relative to the CRA guidance, for those of you who are familiar with the New Markets Tax Credit and may use the Community Development Financial Institutions online platform to figure out whether your project is New Markets qualified. One caution, the census data is actually very similar, but the FFIEC site is, and the place that Sharon directed you in her slides, is where to get the most up-to-date information for CRA purposes. The New Markets site may not have exactly the same kind of fresh data. So just a note in terms of gathering your information to make sure you check FFIEC. And then you'll see here from the financing that this is the kind of project that would be in the middle of the bell curve, under $1 million in historic investment, a loan that was made from a local bank as well to help finance the approximately $5.5 million total development costs for this project. We were fortunate to work with Bank of America and a small deal fund to do this. We often find that smaller investments can be hard to syndicate for folks who want to do one-off investments, but it's a great opportunity to partner together and finance multiple smaller deals over a portfolio of similar standards from the investor's perspective, so you can do higher volume and smaller transactions. In terms of the impacts created, when we look back now and can see the work that was generated from this kind of investment, this block created 100 jobs, 60 of which were full-time, 40 part-time. 40% of the full-time jobs and 80% of the part-time jobs are accessible to low-income people. From conversations we've had with the development team who did this, we know that 50 to 100 of the cosmetology students are trained in the facility, and that the full-time jobs that are available are open to those who don't need to have more than a high school degree. So higher accessibility than you would have in, higher end white collar jobs. We also see a ripple effect in this kind of investment. Even with $1 million in credits, we see a substantial amount of economic activity surrounding this. There's a synergistic ripple effect that's created from this. So both with visitors to the county and with the sales tax and economic activity that's been driven in the city. Much of this has also been done in concert with the Tennessee Theater, that's now seen over 1.5 million attendees since it was renovated in 2005. Another project to highlight that uses a smaller credit investment amount and focuses on investment activity in a smaller community is the Baltimore Remington Neighborhoods Tire Shop. This is a working class community that had a number of challenges following the shutdown of a number of different manufacturing facilities in the Jones Fall Valley. The local developer that we partnered with, Seawall Development, was able to undertake the redevelopment of this project along with others in what they viewed as a way of impacting the community through a multi-pronged redevelopment activity. For this project, they took a 2,500 square foot former tire facility and have turned it into a full service restaurant, performance space for a small startup theater, and office space for an arts and public education oriented nonprofit. Again, we look at the different prongs of how this might be CRA eligible. It is located in a low to moderate income census tract with 59% of the area median income. It also meets a number of economic development incentives as part of an enterprise zone, a hub zone under HUD, and a food desert. So having an additional restaurant facility in the neighborhood was helpful for what the needs of the low-income community were. In terms of financing, this one's even smaller than the 500 block of Gay Street that we mentioned earlier, with under $500,000 in historic credits. This is the kind of investment that is often done by developers who have to claim the credits themselves if they can't find a separate investment partner. So part of our hope with having this new guidance is that many of you on the phone who are working either for a small financial institution yourself or in local Main Street communities or for developers can realize that there is a way to go to your banking partner and say, you know, even for these smaller investments, if you've been our lender, this is where we keep our deposits, you might be able to do an investment with us even if we're not attracting the attention of the larger investors with these under $500,000 investments. Surrounding this one, as I mentioned, are several other things that Seawall has been doing. They did a historic New Markets transaction for a property that's a mixed-use facility that includes housing for public school teachers and space for nonprofits that support public education for Baltimore City schools. You'll see here that the recently completed mixed-use Remington Row includes mixed-income housing, convenience retail, and the neighborhood's first pharmacy. Also shown is one of 30 single-family home renovations that Seawall is completing around these larger projects, thereby increasing the homeownership base in this distressed community. Again, we see a pretty significant number of jobs, especially relative to the amount of historic capital that went into this investment. 55 total jobs created, 30 of which are full-time. Again, 35% of these were estimated to be accessible to low to moderate income individuals, and the project itself is supporting the local redevelopment plan, both for its activity in terms of its actual physical redevelopment, which is eliminating a blighted property and putting something back onto the tax rolls, but it's also a piece of this larger puzzle that's a community-wide redevelopment plan. So in addition to having accessible jobs, it's also a space for nonprofits and performing arts. So it's supporting other activities in the community that benefit both low-income residents and others in the surrounding area. For those of you who are more accustomed to going by larger projects and seeing the financed by local or national bank signs and realizing that it's part of the large master plan, like this part of the Boilermaker redevelopment that's by the DC Navy Yard. If anyone's been to the DC area and been to the Washington Nationals game since the new stadium opened, this is in the same neighborhood where there were a number of former government buildings that are now being repurposed into a large mixed-use development. So what used to be a Navy ship boiler manufacturing plant for the Washington Navy Yard has now been turned into use that provides restaurants, bars, and retail, both supporting the local affordable housing development that's now being done again in the area, but also the increase in foot traffic and otherwise because of the baseball stadium. If anyone in the audience was with us at the National Interagency Community Reinvestment Conference in February, John and Barry and Leanne all spoke, and I got to listen in the audience. They were also joined by Mike Novogradac, who many people know for Novogradac and Company's work in different tax credit areas. This was a case study that we worked with Barry to provide when the Q&A was still in the development process. So a way for us to be in communication with the OCC and other bank regulators to talk about how a retail development project in a community like this would also meet the CRA eligibility requirements. This one is in an area where you have 60%, 62% area median income and an extraordinarily high unemployment rate. So there are adjacent buildings in this complex that were also financed with New Markets, especially because of the economic activity driven by the job creation aspect of it. This is a larger transaction with $4 million approximately in historic tax credit. And the community impacts at this scale were also pretty significant. NTCIC engaged a local company who does economic impact analysis to interview the developer, talk to each of the retail tenants, and get more information about were we really drilling into what the needs of the communities were. We found that the wages provided are significantly higher than what local wages would otherwise be. 80% of the jobs are actually taken by DC city residents, and 60% of these didn't require a college degree. The employers also expect and have seen more recently that almost none of their employees have a vehicle, but because this is located close to a metro station and other transit-oriented development opportunities, it's an accessible job opportunity, not just for the type of job, but for the ability to get to a job. And then finally, one quick example in terms of a hotel. Many people think that hotels could be a challenging asset class, and from an underwriting perspective, that can be true. We find that they are tremendous job generators. So if you look at this former Audubon building on Canal Street in New Orleans, it was built in 1909, was open for many years as an office building, but was closed following flooding from Hurricane Katrina in 2010. It's now been redeveloped into a 168-room Indigo Hotel. Importantly for the community, while Canal Street attracts a lot of people's attention, both New Orleans and elsewhere, for being one of the iconic strips of economic activity in the city like New Orleans, this is actually a pretty tremendously needy area in terms of creating job opportunities and economic activity that's keeping dollars within the city. Here you've got an area both with high unemployment and where the wages are 43% of AMI. It's also not just in a federal disaster area because of Katrina, but also the downtown development district and several other state and local economic development districts. Again, in this transaction, we brought in our economic consultant to talk to the owner, to talk to the hotel operator, and really drill in on this question of if you're a person who gets a job as a housekeeper or as a cocktail waitress in the bar, do you have an opportunity not just to get a job based on what your experience has been or the degree requirements might be, but can you actually have a job over time where you've got increased opportunities for higher wages, management experience, et cetera. In our experience, hotels are somewhat unique in this ability to bring in people at very low levels and hire them and train them from within and give them better opportunities over time. And our investment in the Saint Hotel bore this out as well. So I will hand the mic back over to John, who will invite folks for questions if you might have them.
All right, thanks, Marilyn. Thanks to all our panelists for a terrific job. So we're going to have a chance now to do Q&A, and we'll keep the webinar going until we complete any questions you may have for us. Before we do that, though, I wanted to ask if Barry Whitus has a comment he'd like to make.
Yes, good afternoon, everyone, and thanks, everyone, for their great presentations. I just wanted to elaborate on a point that Leanne made that referred to our office, the Community Affairs Office at the OCC in Washington. Our office administers what's called the National Bank and Federal Thrift Public Welfare Investment Authority, which is a specific legal authority by which national banks and federal thrifts that we supervise can make equity investments in real estate projects, such as the types of projects that were described during the webinar today. So those filings must be made via our policies and procedures outlined on the OCC's website, and that does require the national office at the OCC Community Affairs to review them, and then we provide a letter to the bank or thrift specifically acknowledging or approving the investment. And that's the reason why Leanne would have a reason to have her bank, Bank of America, interacting directly with our office in Washington. There are many financial institutions that are not national banks or federal thrifts that are supervised by the states. operating under a state charter, and those banks and thrifts that are state chartered would work directly with their primary supervisor in determining the legal authority to make the investments. But in order to make the investments into the national bank or federal thrift, Public Welfare Investment Authority, they do have to have certain economic development and LMI job creation components or affordable housing components similar to the types of requirements that were described for CRA. And so that would have the reason why we would interact directly with a bank or a thrift that has questions about whether or not the projects meet the requirements of both the Public Welfare Investment Authority, and we'll certainly give our thoughts about the CRA component, which is actually different, that comes into play when a bank is trying to qualify that investment as a CRA-eligible investment for, in the context of their examination. So I just wanted to make sure that we were clear that not every bank would need to or be expected to come to the OCC in determining whether or not an investment qualifies for CRA. The banks and thrifts that we supervise have supervisory teams working directly with them and would be a resource as well to consult with if they had a question, a bank or a thrift had a question about whether or not the activity would be an eligible CRA investment. So I just wanted to make sure we clarified that point, and I'm happy to answer any questions about that during the Q&A. And again, I think everyone did a great job. Hopefully it's clear, but we're here to answer your questions and look forward to responding to them. Thank you.
So while we're waiting for questions from the audience, Barry, while you got the mic open, I had one for you. So we have a number of Main Street managers on the in the webinar, and is a designated Main Street district a qualified economic development area for purposes of CRA?
Well, when you say a designated Main Street, are you referring to a designation that is being made by a state or local government with respect to a particular district? Or tell me more about that, because we generally refer to an economic development district or targeted area as one that's sponsored by a state or local, or in the case of the hub zones or enterprise zones, a federal entity. So I'd want to know more about what that designation is and what a governmental agency's involvement in making that designation.
Some Main Streets are officially designated by a state Main Street program, so they would have the imprimatur of the state that they're in. Some are designated by local government. You have Main Street managers often are employees of local government, so there's an economic development plan that may be more like locally driven. So it's usually one level of government or the other.
Well, I think the goal more than anything else is to make sure that if a governmental agency, either call it a Main Street plan or any other type of plan, enterprise zone, economic development district, whatever its name, it's been promulgated by a governmental agency and has as its goal economic revitalization, job creation, the types of public benefit criteria that Sharon described during her slides. And then what you want to make sure is that a project that is then initiated in conjunction with that plan is consistent with that effort. So if the goal is to rehabilitate dilapidated or vacant properties with the goal of bringing in new jobs and bringing greater economic vitality to that area, then that certainly would be consistent with, the objectives that, I described of a government plan, be it a Main Street or other type of plan for revitalization.
Okay, and question I have for you, Sharon, I talked a little bit earlier this week by email about the distinction between projects that have to be in an LMI area or a distressed or underserved middle income geography, and then we talked about projects that are primarily small business support projects, and that they have sort of a different, there's a difference there in terms of whether that actually has to be, that project has to be in an LMI area or a distressed or underserved middle income geography. Could you elaborate a little bit on that?
Well, there are sort of two prongs that something like small business development might be considered under. It might be either considered under the economic development prong, or it might be considered under the prong that deals with revitalization and stabilization. And there's, slight variations between the two. So those would be the places to look for the guidance to, see if your project fits within those categories. And under revitalization and stabilization, I went through, the four subcategories there that included LMI, as well as designated disaster areas and distressed and underserved areas. So in each of those categories, you have to make sure that, you fit in with the different Q&As and the guidance that's in the different Q&As to see, how your project would slot in there.
So if you go to the FFIEC site, and you're not designated or underserved middle income geography, and you go to the site and you see you're not an LMI area, but you have a project that is 100% providing space for businesses with less than $1 million in annual revenue, or whatever the requirements may be higher for small business development companies, I guess the answer is don't give up. There's some
don't give up.
There's some traction there still.
Yeah, in that instance, you go look at the economic development category, right, and see whether you fit in under those requirements, and that's the size and purpose. So the purpose would have to be to help either small businesses or farms by providing economic development, and would have to be of a certain size. And those specific requirements don't apply in the same way in the revitalization and stabilization category.
Okay. I have one other question. So does every bank have a CRA officer? I mean, if I'm out there, I'm the president of a small economic development corporation. I've got a project I'm promoting. I've got a developer in mind. Who do you call at the bank? I mean, is there a list of these folks? I mean, how do you find out who's the right person to go to? Barry, I'll throw that one to you.
Well, I would say if you're dealing with a very large financial institution, I've noticed that, and maybe Leanne would like to comment in terms of Bank of America, but there are people that work specifically on economic development type programs that use federal tax credits or other federal dollars or state and local dollars as part of the deals. I found that the entry point for those transactions might, in some banks, be different than your traditional commercial lending operation. If you're dealing with a community bank, I would tend to go to the president of the bank or somebody very close, since these tend to be very unique transactions, and if it's a smaller community bank, they may never have done one before. So you want to make sure that you get into the bank at the right place where there would be greater interest possibly in the good of the community or community revitalization effort that is the kind that Leanne was describing, motivates Bank of America to be involved. Not every bank has a CRA officer, and that's not always the right entry point either, because that is often a person performing a regulatory function and are oftentimes not directly involved in a deal flow. And so if you went to Bank of America, their CRA officer, is very much ensconced in a regulatory function in one part of the country, and it might be a business development officer working around community development, that would be the better entry point. I don't know, Leanne, do you have a comment as to at Bank of America or other banks that you've worked with where the best entry point would be?
I do. I think the best entry point is generally the person on in a larger institution anyway, the person on the line side who's looking at the investment. They will know who to contact within, if they need to involve the folks in their CRA group, they'll know how to get a hold of them. But so larger banks, I think, focusing, they're typically line people like me who are looking at making investments. Whereas smaller banks, I could definitely see how you would generally have more of a CRA investor who might also be, or CRA officer who might also be making investments.
Okay, well, we've got a very shy audience. Oh, we do have a question. And the question is, would it be considered CRA points if it's a loan to the city for revitalization to build a park, for instance?
Well, that's another. This is another facts and circumstances question, but for example, if this is in an LMI area that's being revitalized and stabilized, and it's part of the city's plan, then there's a case that could be made. Case could be made same in the other types of revitalize or stabilize. Again, is it part of the bona fide plan to revitalize or stabilize the area? So if a park is consistent with, putting in, say, an affordable housing development and the park is next to it, you could certainly make the case.
So, next question, Sharon, this may be also for you. What is the population cutoff for a non-metropolitan area?
There is no population cutoff. I think there is a formula for determining distressed and underserved areas. The formula is actually in the regulation, and I cannot recite it. It's HUD actually does a lot of work to develop those areas. They're periodically reviewed, and so I'd say the best way to get a sense of it is to go look at the maps on the FFIEC website.
Yeah, I mean, we're talking about areas that are generally under, non-metropolitan for the census purposes, I think is under 25,000 population. So we're really talking about non-metropolitan areas being areas outside of those major U.S. cities, and it has to also be distressed or underserved. And so, as Sharon said, if you go to the FFIEC website, it's got a list of something like 3,500 or 4,000 census tracts that are listed by state, and that would be, your definitive answer as to whether or not you're in one of those geographies or not.
Next question. We own 16 buildings in a rural community of 1,700 people. The buildings are all currently vacant but have great bones. It's basically the whole downtown. Can we use these for mixed use with apartments, lofts upstairs, and retail downstairs?
CRA consideration is available for mixed use. Here, I think you would look at what amount is being, A, is there affordable housing in the housing component, and how will that be looked at? And then in the retail component, you would go through the kind of analysis that we've talked about today about, the job creation, et cetera.
Okay, next question. The example being discussed now is similar to what we have in downtown Lewiston, Idaho. We now have the opportunity to revitalize an iconic historic building, but the costs are going to be in the region of about $20 million. Would CRA-HTC help with funding this project?
I'll jump in on this one. Probably. It depends on some of the other facts and circumstances related to the census tract information, the community information about where the project's actually located with some of the examples we've gone through today. There's another question that's also asked on here about a property that's in it's a bank branch, and the bank still occupies part of it, but there's a vacant upper story or two, and is that something that can be done? In both of these instances, I would say yes, the historic credit could be part of the capital tools that you bring to bear on it. The credit, depending on what state you're in, would be a 20% federal credit. There may also be a state credit that can be added to it for the project in Ohio, for example, or many other states. 33 states have companion state historic credits. So there are some limitations on having nonprofits fully occupy a space, but for a for-profit business that's occupying it, the tax rules would permit it. And then depending on who your investor is, you'd look into this question of whether it's CRA eligible, so the bank is fitting it under that umbrella if they need to, or if it's not. Another question that has come up from the audience is, if we know something may not qualify, then what? There are investors out there who will finance projects that are not CRA eligible. Some investors aren't regulated by these bank regulators and don't need to meet these requirements. And even individuals can claim the historic credit in certain circumstances. So don't lose heart, even if you've gone through all of these different rules and you found that your particular project might not fit under the umbrella. There may be a different way of getting historic tax credit financing for your project, even if it's not CRA eligible.
Okay. Are there flyers or handouts we could take to our community banks and investors with this information? The answer is yes, and we'll be sending this entire slideshow plus the audio out to you within the next 24 hours. And so, again, please feel free to share that information. And if after that you have specific questions, please get in touch with us at historiccredit.com.
I'll just add on that point, John. The very last page of Sharon's presentation actually provided 3 documents, 1 web resource and 2 actual handout type documents. One is our insights report that we actually work very closely with the NTCIC on. It's called Historic Tax Credits Bringing Life to Older Communities. And then we also have a shorter 5-page publication on historic tax credits, and it does go into all the CRA considerations that Sharon just mentioned, and it's a document that the OCC has produced. So I think those would be good documents that could be brought to the bank to discuss, opportunities in this area.
Yeah, and we do have this line available to us till 3:30, and so we'll continue to try to get through all of these questions. If we don't, we will definitely get back to you after the webinar. So one, if not the most historically significant building in our downtown is occupied by the Wells Fargo branch bank. The upper 2 stories and a third of the main floor are vacant and have been for decades. Could Wells Fargo utilize the HTCs or the CRA credit for restoration of its own building? If not, is there another strategy that could utilize these tools for this building? Leanne, you want to tackle that one?
I can't tackle what Wells not do. So to the extent, I think it falls into the same thing we were talking about before. And I'm getting a weird feedback, maybe, there we go. Sharon's points before so that would be a mixed use area. I mean, certainly to the extent that it is a bank branch that's in an underserved or underbanked community, that's something that is a component of CRA. And then it would depend on what the intended uses were of the other pieces to determine whether that would fall within the CRA parameters or not.
Okay, Barry, do you want to take the next question? Are major national banks required to have CRA activity, or is this optional?
Well, every national bank and federal thrift and any state chartered bank or thrift is subject to periodic evaluation under the Community Reinvestment Act. The level and complexity of the exam varies based on the size of the institution, such that the level and scope of activities is going to increase as the bank size increases. So the answer is every bank or thrift is subject to CRA evaluation, but the tests that they're going to be subject to will vary. Generally, I would say any institution above assets of about $1.3 billion is going to have an investment test, and activities such as, historic tax credits, new markets tax credits, low-income tax credits would be the kinds of activities that would be a qualified investment to be considered under that investment test, which does comprise 25% of the bank's CRA rating. If it's a bank of between $300 million and $1.2 billion in assets, they will have a community development test and a lending test. And then this CD investments, community development investments, such as historic tax credits, would be considered under the community development test. And for those size institutions, the community development test is 50% of the bank's rating. So I guess to answer the question, most banks could benefit on their CRA performance by making community development investments. It's only your small banks of $300 million in assets or less that would not specifically have a community development component of their CRA rating or an investment component. Although those banks could make these types of investments and get positive consideration under their rating, it is other kinds of activities, including lending, that drives the CRA performance for a bank of $300 million or less.
But a bank of that size might be incented to do community development work if it wants to bring up its CRA rating, and the community development activity would be considered. Right,
that's exactly correct, Sharon. If a bank of under $300 million in assets is performing at a satisfactory level, doing community development investments could in fact be favorable activity that could bring them up to an outstanding. So the ratings for CRA start outstanding, which is the highest level, and then the next level down is satisfactory, and the next level down is needs to improve, and then the lowest level is substantial noncompliance. Most institutions, fortunately, are satisfactory, outstanding in performance. If you did have a small bank that was, not performing satisfactorily on their CRA performance in terms of the lending and other, for an institution that's under $300 million in assets, they would have to at least bring their performance up to a satisfactory in order to get what I'll call the halo CRA consideration for making community development investments.
So I'm going to try to run through and balance these questions in quick order. So our Columbia and Main Street is not an LMI area. Would investments in this area of revitalization count as CRA points? So I think the first thing to do, if you know for sure it's not an LMI area, go to the FFIEC site and check to see whether it may be a distressed or underserved non-metropolitan middle-income geography. Boy, if there's ever a word that needed an acronym, that's it. If it's not that either, one or the other of those, you really want to be looking at a project that primarily is involved in promoting small business development, space for small businesses as defined earlier. And I think I think you can, you could probably get, make the case for CRA even though it's outside those targeted areas that we just mentioned. You alluded to funding in rural areas. Are there specific investors interested in funding such areas? I think any bank that includes as part of their retail footprint a rural area would be a candidate to be an investor on a rural project. So you need to look at your bank's website, see where they have their retail branches, talk to the CRA officers, see what so-called assessment areas they've established, and see whether your project falls within those areas. Discuss in detail how to promote the benefits to banks when they're both lending and investing in a historic tax credit project for projects that generate less than $1 million in credit. So I think, in particular, if it's a small project where there's a small loan, one of the things we often say to banks is, look, here's a way to get a better return on investment. Why don't you add X amount of cash to the transaction in the form of equity on top of your loan, so you control the entire transaction and you can make yourself a safer loan by making sure that there's enough equity in the project, and therefore the loan isn't too large for the kind of revenue that it'll generate. So I think definitely a good case to take to the bank to do both the loan and the historic tax credit. If a nonprofit were to do the renovation, can the historics be sold to a third party? The answer is yes, as long as that third party is an arm's length taxpayer. And there's some structuring issues that you want a local attorney to go through with you, but the answer to that question is yes. Can you speak to general principles about loan-to-value ratios, public-private investment, and how entity types might affect these percentages? Probably not in the time we have left, but I would suggest if you could, I'm going to ask Melanie to make sure we retain this question, if you could maybe type into the chat box your email address, and we'll get back to you tomorrow. It's probably more than we have time for right now. One of the best ways to determine CRA eligibility of a specific tract or area, I think there again, it's the FFIEC website for both determining whether it's an LMI census tract or a distressed or underserved census tract. Same thing for the next question. Private foundations are not a source if a private foundation were to be contributing to a project for a tax-exempt purpose, the project's a daycare center or it's some other public service facility, that's a good attribute and a fact to cite to your investor, to your bank, that there is interest on the part of a foundation in the project. So I think that's a good fact. But foundations themselves are tax-exempt and wouldn't be a candidate to be an investor. We have a building that's given to us by the Board of Education.
John, I think some of these fact patterns folks should email us offline if they want us, if I've got a deal in my community kind of question. Those are such
right.
facts and circumstances ones.
Yeah,
maybe we can skip that.
Yeah, okay. All right, that would be maybe the caller that typed in this question, if you could type it into the message box of the historictaxcredit.com website, hit on the contact tab and type that in, and we'll give you a more detailed answer tomorrow. What is the benefit to a bank for having a superior CR rating? Well, that's a good question for our two regulators.
You know, we will often point to two things. One, obviously, it is something that the bank cares about, its reputation in the community, and to be able to say you're outstanding, will benefit you with your customers. But second, the only enforcement tool in CRA is that if a bank wants to merge or acquire another institution, it has to have at least a satisfactory CRA rating. And as we look at applications to merge or acquire other institutions, we're going to be looking not only at the institution that is acquiring another bank, but at the CR rating of the institution that is being acquired or merged. So and we're quite frankly in an environment where there's a lot of merger and acquisition activity going on right now. So this is a pretty compelling case for banks to have good CRA ratings.
We're going to have to end our session here. We are running out of time in terms of what we've reserved for this slot. But again, I want to thank our panel for a terrific presentation. Also, those of you whose questions we didn't get to, please type them in at historictaxcredit.com and we'll get back to you within the next 24 hours. Thank you for being a great audience, and have a great day.